Good afternoon, traders. Sound check, please. All right, fantastic. Thank you, Martin, Frank, etc. Hope everyone's having a great trading day. I'm Dan Gibby, Chief Option Strategist for Master Trader. Welcome. We are going to show you, we have a very exciting webinar here today that my partner Greg Capper and I are going to present together to show you the magic, if you will, of this high probability option trading strategy. And yes, we have occasional losses, but our weekly options trader, we've just booked 33 straight gains. And we're going to teach you the exact patterns to look for. And as an incredible bonus, we're going to show you exactly how we do this every single day, because our goal is to teach you how to do it yourself. Our obligatory disclaimer: whenever we're trading or speculating or investing in the markets, we're making a calculated risk. Everything's about risk to reward. So of course you can lose money, particularly if you don't know what you're doing and don't have the proper education. Let's begin. We're going to keep it simple because that's what we do. These are the only possible things that a stock can do. They can go up. That's an uptrend. They can go down, a downtrend, or they can chop around in a sideways consolidation. Our methodology is to use compelling patterns, and we're just predicting a short-term turn in the underlying. Anything that's liquid, optionable, a stock, an index, a future, a commodity, a currency, we can use these strategies to make money every single week. So we're going to find the patterns and sell options around those patterns, and we get to keep that money as long as that short-term turn holds. It's that simple. And then we just manage in between. So what's a bull put credit spread? I'm going to define it for you in a moment, but we're going to be selling an out-of-the-money put below support. We're going to buy a further out-of-the-money put, and let me get my drawing tool. So here we're talking about an uptrend right now, or a sideways trend when we're selling bull put credit spreads. So as long as the stock continues to go up, as long as it just goes anywhere except not under this support, and it can actually even go down a little bit as long as it stays above our break-even point, we profit. There we go. So the premium that we're taking in by selling these options, we refer to it as our cushion to be wrong. We don't have to be perfect. When you buy a stock, you're only going to get paid if it goes up, not with selling options. So similar to an insurance company, we're getting paid each day that as long as there's no unexpected disaster gap against us. But the way we manage things, even if it does go against us a little bit in trade management, that's why we're able to have such high probability trades by booking 33 in a row. And that's exactly what we're showing you here today. So again, we're profiting through what's called time decay. When people buy options, calls, or puts, that costs money. So if the stock does not move in the intended direction, that option is a wasting asset. So we as option sellers are putting that money in our pocket and profiting from that time decay that's occurring to the option buyer. Again, when you swing trade stocks, we at Master Trader like to have clean, precise, beautiful patterns before we recommend a directional stock or option trade. But when we sell options, like we're describing in this webinar right now, we can find opportunities in any single market, any day. And that's what you're going to see the magic of Greg and me working together. We just on the spot. I mean, Greg can find trades scanning his iPhone in an elevator because I have witnessed it. So we can do this all the time. High volatility is a plus. I'm going to show you why, but the reason we like high volatility is because the options that we sell are more expensive. So we are getting paid handsomely for selling those puts to the put buyer who is scared and trying to either speculate on the downside move or protect their portfolio or whatever the case. You don't have to time entries with precision, like I mentioned. So we're just getting paid to predict where the stock is not going. And we're doing this for a short amount of time. Our Master Trader weekly options trading advisory, we only give recommendations where the option expires 10 days or less. So that's the length of the prediction that we are making, maximum of 10 days. And, we close the majority of them before 10 days because we get the majority of our profit. So you might have heard the saying, don't try to squeeze blood out of a rock. It's the same thing here. When we get close to our maximum gain, we just exit the position. Right before this webinar started, we just exited 2 more. So we're really up to 34 winning trades. So here's the weekly options trader that I mentioned. And in this webinar, we're going to show you the magic of how we pull this off consistently. And again, of course, we have losses, but these are all documented in our open and closed trade spreadsheet. And I noticed that a number of folks with us here right now are current subscribers. So, they can attest. These are all real and public. So we're just combining the Master Trader method using chart patterns and volatility to sell options around patterns. That's that simple. And it's we said that you don't have to be precise like trading stocks, but we get these opportunities every single day in gaps, earnings trades. We have failed patterns. We have turning points in the indices. We have volatility trades. And we have our own portfolio of about 80 of these liquid stocks, commodities, currencies that we monitor all the time. Plus, of course, we go outside that portfolio when we find great opportunity. So for those of you who have not subscribed to this and see what this service can do in terms of generating weekly income for you, go to mastertrader.com/weekly-income and check it out. But here we go. These are the patterns that we're looking for in selling the bull put credit spreads or naked puts alone. And obviously we do it on the bearish side. So, just flip this chart upside down and everything is identical to sell bear call credit spreads. These are all bullish patterns. And it depends on multiple time frames of how long we're happy to be in the trade. But we're focusing on selling the short-term ones. So these are all beautiful short-term strategies, which we obviously teach in our Master Trader Technical Strategies course, MTS. And that's why Greg and I are magical together. He's the master at technical analysis. We've been working together over 20 years. I've been trading options 25 years. So we're combining the technical expertise with option trading to deliver these easy to find, easy to trade, easy to manage selling opportunities. So this green line is our support. That would be where we're looking to sell puts. And you can either do them naked if you're okay with assuming the risk, but we prefer selling or buying an out of the money put. And that's what's called a bull put credit spread. You put it in as one order with your broker. We always try to get filled at or around the midpoint. Always use liquid options. The credit that you're taking in for selling this bull put credit spread, whenever you sell options, that's your maximum gain, your maximum loss, or your cost basis is the short put less the money you put in your pocket. So that's the cushion that I refer to as cushion that you can be wrong. Trevor, yes, we will be recording this, and I should be on YouTube live. And if not, we'll put it there afterwards. Now, every one of these trades, I mean, I could give you 100 trades because we do this every single day. So these are all recent within this month that we're presenting this right now in February. So this is the S&P 500 ETF Spiders, SPY. This is our go-to instrument of selling out of the money puts or put spreads during mini market crashes. And so our subscribers know, and that's partly why we have the so many consecutive gains right here, is because we love these crashes because volatility is rising, fear is rampant, and we get paid a lot to take the risk of selling these put protections to the put buyers. Let's look at the math. These are all real trades here. So as the spiders were crashing down, we had two support levels here. Now, there is no way, and this actually was a Friday into the weekend. People are scared. The market has fallen a lot. There's no way I would buy this stock. But look at the magic of selling these expensive premiums. The stock is trading right at around $264. We sold the out of the money $245 puts and $235 puts. And we got, I don't have the actual numbers here, but I'll show you one on the next page. We got paid like over $2, $3 for this, for only risking, we're only risking 2 days and 4 days on these two strikes that we did. But notice, traders, notice the following. Look at the two support areas that I have marked here, 255 and roughly 263. $245 strike and $235 strike is $25 away. You can't even see that number on this chart, that it's so far away. So ask yourself the following question. Look at the 255, the bottom horizontal green line. What do you think the odds are of this crashing below 255 within 2 days? Could we have sold the 255? Absolutely. But we went another $10, $20 further away of protection. Now, let me show you another actual trade on the SPY. So this actually was the day after the prior slide where the market did gap down, but, and I should have had it marked here for you, But look at the clock on the bottom, Eastern time. So 9:30 a.m., obviously market open. And so you can see the pre-market trading had a beautiful, beautiful higher low retest double bottom with a bullish engulfing right into market open. Could you have sold more out of the money puts? You pick the strike price. We obviously teach you how to do that in our full option strategy series course, where we teach you, proper directional trade or income trade based upon your expectation of reading the charts and then your trading plan. But, obviously can't get into that now. But let's continue through the day here on this 5-minute chart. And after I'm done talking on this slide, you should be salivating on your keyboard. Yeah, there is sound. Greg, maybe if you can help some of these questions. Okay, so let's follow along. Let me get my pen out again. Okay, so this is pre-market 5-minute spiders. Beautiful, beautiful, beautiful retest. Could we have entered this 5-minute high? Answer, absolutely. That would have been a beautiful trade. Still, remember I mentioned the 255 strikes? It still held that. So we sold the 245s and the 235s. And even with this nasty gap down, it didn't come anywhere near our strike price. So you could have sold more 5-minute high, filled the gap, pulled back into 11 o'clock reversal time. At this star, we have our bottoming tails here, right at the 5-minute high, minor support area. So this is a snapshot of the puts at this point in time. So this was a trade that we gave to our weekly option trader subscribers. And when we see blood, if you will, we get aggressive because times like this don't occur where everything is in alignment, so we get aggressive. So we probably gave 4 or 5 of these naked put and bull put spread trades on this. We also did bear call credit spreads on volatility products, the VXX, but again, we don't have time for that today. Let's see, a quick question. Why the SPY? Many more benefits to SPX. There's, Bill, the spiders are very liquid. If you're trading options on the S&P index, there's nothing wrong with that. I typically find greater credit for the spread width in trading spiders. So when you have something that works marvelously, why do I need to go hunting around to trade another product when they're the same thing? It's just the little contract versus the big one. All right, let's continue. So we sold the two. So again, I got to keep highlighting this because if you aren't salivating, you're not following this properly, and you need to take my option course. So I can't even see what number this is, but let's just call it 255, okay? So the stock, bullish it had a bearish gap down, bullish move, higher low. Here was another place you could have added, but let's just focus on this star. Let's just eyeball this to the right. Let's just call it 262. Ladies and gentlemen, look, and this is position. So this is me. This is my position. Excuse my inartful drawing. I can't even read it now. So it's let's just call it $1.80 a share. So I have to let this sink in for those of you that this might be new to, because it's just so exciting. We get excited about doing this every day, and our weekly options trader. The spiders were trading at 262 with a bullish pattern. That's step one. Step two, we match the proper option strategy. Could I have gone a higher strike price, further dates out? Yes, we did all that. I told you we gave at least 5 trades. And then we have our regular market edge advisory letter. I gave another 5 in there, different strikes and so forth. But just to show you the math and the incredibly high volatility in times of market fear. 240 less 262 is $22 of cushion to be wrong. You don't need a calculator, but 22 divided by 262, I don't know, what's that, 8%? Do you think the spiders are going to go down another 8% based on the charts, not just going into wish hope mode? And if you sold a 10 lot at $1.80, that is $1,800 going into your pocket for 1 day of risk, and the spiders can go $22 against you. Are you now salivating? You should be. Could we have kept this open to let it expire worthless in 1 day? Absolutely. But while we're in trade management mode, and this is, you put on your hat as if you're an insurance risk manager. So this was, we put this on at 11 o'clock and just eyeballing this, 12:45-ish. So in less than 2 hours, I went to the gym. I always go to the gym over lunch. This is what I do. I just put a bid out to see if I'll get hit. When I came back from the gym, which was right here at the top, I closed my 240 puts that I sold for 180. I closed them for 10 cents. I'm out of the trade. Why do I want to try to squeeze more blood from that rock, 10 cents for another days of risk? I'm just on to the next trade. Marvelous trade. I'm on to the next one. All right, let's continue. You can see I get excited, so I spend a little more time. Just a couple more examples. You're going to see the flow, and then, as promised, Greg's going to get on, and we're going to show you, this totally nothing scripted, because that would be misleading. And we're just going to show you how we find opportunity, not only for our own pockets. Greg and I trade ourselves. An educator that can't walk the talk, you shouldn't be listening to. But if you have a full-time job, whatever, and you just love our trades, fine. You can profit and just be a subscriber to our letter, or you can learn to do this on your own. But we're giving you a great course right now to show you the opportunities with this strategy. Here we go. NUE, another pattern. The market, these were all at the same time in February after the market had that big sell-off and was trying to bottom. This was a sell-off to major support with a bottoming tail, and we had minor support also on the weekly chart. So am I going to buy the stock? No, that's not a bullish, compelling pattern using master trader strategies, but it's an income trade to us. Again, the source of our weekly option trader. We had 96% implied volatility, a rank, which means over the past year, it's 96% high. And that means we're going to get paid for selling puts. Here's the trade we put out. We're going to sell the out of the money $59 put. We're going to buy a further out of the money put just to limit our risk, and also limits the capital requirement. So those are the two reasons why we prefer spreads over naked. Less capital requirement, and in the event of a catastrophic gap, we know our maximum downside, which is a whole lot less than selling naked. We took in 45 cents a share. So if you did a 10 lot, that's $450 hits your account. You might think, Dan, come on, 450 bucks. Yeah, but we have multiple trades going on at the same time, plus the probability, the reward to the risk is phenomenal. So 450 here, 1800 over here, 375 over here, and you can still have a full-time job. So this is an awesome income strategy, hence the name of our letter, Weekly Options Trader. So 45 cents a share divided by the margin of $3.05 a share, 14.7% are return on your capital. Now, I just, here, look at the chart right here. I have overlaid, I just grabbed this morning, what the chart did do since we sold that put. And you can see it rallied up, had a wide range bar to resistance, but we weren't in the trade anymore because it was only 5 days to expiration. We're calling short-term bottoms. Next example. Came down hard with the market. We had so like the whole market came down hard, but we have a CBS is a climactic buy setup, major support. This red is the rising 200 moving average. We had pickup in volume, but this is key. This prior fluid sell-off, this you will learn in our Master Trader Strategies course. This was a gap down, small bottoming tail, range expansion, engulfing bar. That's what got our attention. So it was on our watch list, and then we had 2 more days of consolidation, this beautiful bottoming tail, resistance, price void above. That's a term we use that says there's not much resistance until we get all the way back up to the thick resistance. I mean, think of these as like football players. There's a lot of football players here. There's not very many football players on this collapse down. Now, let me show you what this stock did. And I also just grabbed it this morning. See this, what I just overlaid there? The stock ripped to the upside. Now, we actually gave, this one was a bullish directional trade to us. But remember, I mentioned we had 2 letters. We're just focusing on the weekly option trader right now for selling options. But in our advisory letter, we actually gave them 2 trades on this. We gave a bullish directional trade, and we have a whole toolkit of what to do there involving both stocks and options. And we also gave them an income trade, but not a 5-day trade. We gave them a more of a longer term trade, I think. Question, if the trade goes against you, how do you determine when to close? Okay, let me slow down. The question is, if the trade goes against you, how do you determine when to close the trade for a loss? Quick answer, we always use the charts to make our entry and management determination. As long as the pattern is not destroyed, then we will possibly just sit in it and do nothing. We might roll it, rolling it to further out in time or price to give us more time decay income. And these are what I refer to as adjusting strategies. Or we might add a position to it. And see, that's the benefit of trading options. I refer to stocks as, unidirectional. They only go up or down. They only go forward and back. Options are 3-dimensional, and you can pull out your option toolkit and massage your position based upon your changing bias. So the answer, Scott, is we stop out if the pattern's destroyed. And if it's not destroyed, then we manage it with adjusting strategies. Let's continue. Roku, I told you I was giving you current stuff here. This just reported earnings this morning, but we knew that. This actually pro gap is the prior earnings. So then pro gap, now we have a multi-month consolidation. You can see my support areas here, bigger one down here. So we sold this, and we very selectively hold short options over earnings. It has to be a compelling pattern like this, or it has to be something that we don't mind taking assignment at the improved cost basis. This had 100% implied volatility because we knew that we were selling an option where the expiration was after earnings. But check this out. The stock's trading at $45 and change. We sold the $30 puts, $15 away. So 9 days to expiration. So that's our 10 or less. That was 34% cushion. Our break even, if we did nothing and just woke up and saw what happened to our position, when you sell options, one of two things are going to happen if you wake up the day after expiration and see what happens. It's binary. It's A or B. A, the premium you took in is 100% profit. If it expires, worthless. So if you sell a 10 lot on this, $500 went into your pocket on day one. It expired worthless, so it's yours to keep. Scenario 2, it expired below the short strike price, which is referred to as in the money, and you are required to buy it, the stock, at $30 a share, because that's what selling a put does. You're obligating yourself to buy the stock at the agreed upon price on or before expiration, and you're putting money in your pocket. Your cost basis is $29.50. That's your scenario B. And the stock did gap down to $40 today. So it was, I mean, I didn't put a current chart up here, but the stock rallied to like $50 and gapped down to 40. So it was still $10 away from our short strike price. But just for your information, because it's another trade management tactic of ours, on the 2-day rally after we entered this thing, it had a nice rally. So we closed it at 15 cents a share. So we booked over 75% of the maximum gain just to avoid that gap risk. Now, that was a personal decision. Individuals can make their own decisions, but we were out of the trade making 75% of max gain in 2 days with no gap risk. All right, another example or two, and then I'm going to turn it over to Greg, and we're going to see if we can find, all of us, some trading opportunities into the close here. Intel. So Intel had a pro gap on earnings right here. Pro gap breakout on all time frames to multi-decade highs. If you look at the monthly chart, it looks great. So we were comfortable with this. Was one we were comfortable of, either taking assignment of the stock as a core trade or rolling it to continue to make our weekly income. And this is another one that we have in both of our trading newsletters. So I'm going to walk you through our weekly options trader, of course. Let me clear this again to show you. And these are all, again, look, it's February. These are all very recent real trades. the first one we did, and we sold the $45 puts, 29 cents a share, 5 days of risk, and it actually went against us. So let's Scott was asking, what do you guys do? You know, so many people like to show, you know, just show off their good stuff and not the bad. Well, here's one, Scott. It went against us. But because of the bullish multiple time frames, we did not stop out of this one. The pattern is not destroyed. It's a deep retracement. Yeah, that I didn't like, and it was uncomfortable. But let me continue because you're going to see what we did. So we're in the trade. This is what we did now at the star on the top left here. I'm going to keep getting my drawing tool out here. So it came down hard. Our 5 days was coming close. Well, this was day one. And we actually, you know, put this trade on in the morning when this bottoming tail looked like it was holding this nice minor support area. That's why we put this trade on at the time. But it went against us. So we just dealt with it. And we sold the $45 puts, which is right here, this number. So a couple days later, once I had this nice bottoming tail, here's what we did. We rolled those $45 puts down to the $44 puts. So when you roll them, we rolled this what's referred to as down in price and out in time. So we sold 7 days the next week. But here's the beauty again of selling options, folks. We put another 50 cents a share in our pocket. Plus, we gained an additional dollar of cushion. So that's where we were at that point in time. The story's not over. So now we had the bottoming tail held right on major support. It moved up, inside day, nice engulfing day. So on this next day, we sold some more puts. We sold the 44.5 puts for 21 cents. So now my total credit received is $1 a share on a 10 lot. That's $1,000 on Intel. And over the high of this current bar, you can do it again. So Intel's one that it's kind of been a go-to stock for weekly income. This is one we put out yesterday, Wynn Hotel, and it hasn't triggered yet, but it's still going to be a valid trade for us. So I encourage those of you interested in wanting to paper trade is put Wynn on your list. So it's major support, but the way it came down hard and ugly on the bearish, you know, news on Steve Wynn, it got clobbered to support, has a lower high, and it's not rallying with the market. You know, the market's been up, what, 6 days or so off the low, and this thing's just doing nothing. So our income trade under 162 is going to be shorting an out of the money bear call credit spread. And I posted this yesterday, so we obviously aren't in it for the 3-day expiration. So what I'm going to do for those of you in our weekly option trader, I'm just going to adjust the parameters and say that it's okay to sell for next Friday. And it's still, you know, sometimes people ask me, hey, how long, when a trade's not triggered, how long is it still valid? The answer is, it's going to be related. So this is a good lead in maybe to Greg. The answer is it's a valid trade as long as the pattern still makes sense, timed with the market, and the credit received still makes sense. So actually, Greg, maybe this is a phenomenal, just by accident. Let's look at this trade, and I'll look at the next week's, and let's analyze this. as a valid trade. But here's just the math on it to continue. So if we did sell that $10 wide spread and we got, it was 111 at the time, I have no idea what it is right now, and you divide that by the capital requirement of 889, then that's a 12.4% return on your capital, provided it closes below your short strike, which in this example is 167.5, which is always over resistance. So ladies and gentlemen, that is our approach, but I was kind of showing you the output, and now Greg and I are going to show you how we find and analyze these opportunities, that we put them through. We have a process, we have a methodology, and they have to meet our methodology of risk to reward and compelling pattern before I'll trade it and before I present it to our subscribers. I mean, I wouldn't give anything to our subscribers that I wouldn't do myself. So it's all in the same. Let me see if there's a question here. Are there wash sale issues if you sell puts in the SPY and Intel many times over and over? Not to my knowledge, Bill. You can ask your CPA, but no, these are just I don't see one. A wash sale is when you sell something and rebuy it within 30 days, and we aren't doing that at all. We're selling speculative options for income. We aren't taking in, we aren't buying and selling stock. But I'm no accounting expert. I let my CPA handle all that stuff for me. And I know there's a lot of questions here which I did not get to. So please, in the comments section below, hey, and this was good timing, Greg. I just got an alert on Wynn. I had my alert at 163, which just went off. So I think that'll be a great stock to look at together here. But yeah, please post your comments in the comment section below, and or email dan@mastertrader.com, greg@mastertrader.com. Okay, as promised, this is our approach that Greg and I do in detail over the weekend. I don't know if folks know, well, of course they don't know this because you don't look behind the curtain of watching Greg and me work together, and that's what we're going to give you a sample of right now. But on the weekend, we spend together a lot of hours, coming up with great Greg's market analysis, and then the stock and option picks, etc. But let me continue. So this is what we do in detail on the weekend, but we're going to show you how to do it live right now. But this is our general methodology. Greg coined the phrase techno-fundamental approach. I'll let him, talk about it more when he comes on in a second. But we're looking for high probability sectors and stocks to trade, stocks and options. But for this webinar, it's options. So you start with the broader markets, then the sectors, market internals, stocks of interest, then throughout the day, and Greg has great, scans, which he's going to show you a couple of them right now. But we're always looking at gaps, news, movers. I have a high volatility scan on my Thinkorswim platform that I created. So once we have our optionable stock, our optionable trades of interest, then I analyze what we can get paid. What can we get paid for assuming that risk? And that's what we're going to walk through a few examples right now. Then I'll trade it. We give the trade recommendations both in chat and email to our subscribers, and then we just manage it. And there's the word adjust, as I was talking to Scott earlier. And these are just two posts to show you how we post chats to our subscribers. But those short puts I was telling you about, that was one of the many that we did. So we sold those $240 puts for 83 cents. We closed them at 10 cents. So we made 90% of our max gain in one day. The VXX I told you about. So see, the VX volatility ETFs, we trade with the spiders. They're two tools that we trade together. And I have a fantastic, for those of you wanting to become an expert in trading these volatility products, there's unfortunately a ton of junk out there in the market of trying to teach you their magical nonsense. And I'll just leave it at that. I have a 65 slide, 4 hour incredible course on trading volatility if you're interested in that. But that would show you the recipes of how we trade volatility products. So this VXX was just one, and you can, if you can read it there, we said provided the spiders trade over 263.95, then we're going to short this out of the money bear call spread. 3 days to expiration, we got 67 cents a share. And the VXX was, I don't know at the time, but the $70 call was like $30 out of the money. So again, we love selling volatility, and we love selling puts on the spiders in market chaos. And all the other times we're selling these credit spreads to put money in our pocket as additional income, because it really is easy for us. You know, I keep saying it's easy to find, it's easy to trade, it's easy to manage. And hopefully I've shown you some of that today. Hey, Mike, haven't seen you in a while. Old Mike, he's a he's a retired pilot from Alaska Airlines that we've been working together for many years. Welcome. Mike, why? Okay, so Greg, we can look at WLL since we're going to, Greg's going to show us some charts. Is VXX course included in the monthly service? Yes. Yeah, we, in both our letters, the weekly options trader and the advisory letter, absolutely, we trade volatility products in both. Yes. So again, this is the service. I highly recommend. I've shown you the output of the service, trades like that, and so it's only $39 a month, and it's only $19 a month if you're a subscriber to the advisory letter. At least I think you owe it to yourself to give it a shot and just paper trade it and see if our methodology is consistent with your trading comfort zone and profit potential. With that, I'm still going to be here with Greg, but Greg, why don't you take over the screen, and we're now going to do our magic of Greg's going to look for opportunities, and you're going to hear us talking together with the mic on as if he and I were in a private room together looking for trades, and we're going to try to find some right now. But Greg, let's look at that Wynn, and then also the VXX course you talked about. No, the VXX course is a whole separate course on the website. You can check it out. And again, I want to be cognizant of everybody's time, and I see the market coming in. So this might be a great time to sell some out of the money bear call credit spreads, but you can email me or Greg. So Greg, take over and let's look at Wynn, WLL, and anything else. Let's try to find some profitable trades right now. All right, Greg, I see your screen trying to come up. And can you talk, Greg? Because I don't hear you.
Yeah, I can. I'm here. I'm just
okay.
picking the right thing to show.
All right, cool.
Hey, Frank.
And yeah, folks, also a trade that we already have on, but it 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 it's a great pattern for short-term trade is Netflix. NFLX has a nice, two topping tails, a little engulfing bar. Now it's a bullish weekly and monthly, but again, we're just calling short-term tops and bottoms.
Okay, so
Yeah,
you
look
should
at
be able to see.
yeah, Greg, look at Wynn. Yeah, let's start with that one.
First, let me just explain to everybody what they're looking at here. And
Okay, I don't see it yet. Can others see Greg's screen?
no.
Yeah, no. I see your arrow, Greg, moving.
All right, let's see what the story is here. Oh, I'm picking this.
All right, well, I'll just talk, Greg, while you're doing that.
I don't know why it says that it's showing the application. I don't know. New share. Hold on. Share computer sound. Maybe we have to do it this way.
All right, folks, just while he's doing that, I'm just going to talk you through my methodology. So I'm looking at Wynn, WYNN, that we just went over a screen together. So my alarm went off at 163. And yesterday had a failed breakout, had a topping tail, and it's has a ugly red breakdown bar now on the intraday charts. The hourly is